Welcome to our FitBUX Public Service Loan Forgiveness Guide. This is going to be a good one just simply because we get questions on a daily basis about all the headline news about public service loan forgiveness, and less than 1.5% of the people applying for it actually getting it forgiven and all that type of stuff. We're going to walk through all of what you need to know in this guide about qualifying for public service loan forgiveness. But even more important, we're going to hit on the three things that we always talk about at FitBUX: understanding, planning, and implement. So we're going to actually go through and help you understand what public service loan forgiveness is, what type of plan you're on, all the information you need to know there. How do you actually take that and then develop a plan? And most importantly, how do you actually implement that plan, and how do you make it easy to implement and do all these things? So you definitely want to stay till the end of this guide. Before we get started, I want to introduce myself and FitBUX for those of you that don't know who I am or who FitBUX is. My name is Joseph Franke. I'm a chartered financial analyst. I'm also the founder of FitBUX. And we started the company about 2.5, 3 years ago. Within that time period, we've helped young professionals manage and eliminate over $900 million in student loan debt. When it comes to public service loan forgiveness, because of our tracking solutions, we've dealt with Fed loans now for 2.5, 3 years. We know how frustrating, how slow they are. So if you've already experienced them, trust me, we get it. If you haven't yet, because you're thinking about going on public service loan forgiveness, you may run into some of those issues in the future. But that's all about what this video is about: understanding, planning, and implementing. So that way you can make this stuff easy. Now, before we do get into the nuts and bolts of this guide, just one quick thing. We've been able to grow really from word of mouth over the last 2.5, 3 years. And so if you're having these issues on public service loan forgiveness or are thinking about it, chances are your colleagues, your family members, your friends, your classmates, they're all too. Make sure that you share this video. There's some share buttons on the side over here. And also, we have a checklist for you that will help you go through each thing and say, I'm doing this, I'm doing this, I'm doing this. So make sure you download that podcast. If you're watching our website, it's right to the side of the video. If you're watching on YouTube, it's underneath the video. I put it in the comments section, in the notes. And if you're listening to this on our podcast, then it's in the show notes as well. So make sure you can click on that, download it, and make sure you follow that checklist. And one last thing, again, make sure you share this video with your friends. So with that, let's jump right into it. The first part of understanding public service loan forgiveness, and just student loans in general, is actually not about the plans or the repayment features itself, but something that we get all the time of why is it so hard to get help, okay, reliable help. And I say this just because this lesson you can take away from public service loan forgiveness, you can actually apply to a lot of things in finance, okay? And what I mean by that is financial professionals are all very segmented in what they do, let it be real estate and mortgages or real estate sales or investments or financial planning or insurance, or whatever it is. They're kind of like these all little buckets. So you can go to one person that says they're a financial planner, for example, and they're supposed to be an expert in financial planning, yet it's kind of ironic because on some of those tests that they take, there's no questions about debt. So they really don't know anything about debt. So if you go to them like a mortgage or anything, they have no idea how to help you. And when it comes to student loans, they got no shot because it's just, that's not what they get paid for. They get paid for investment advice and insurance. So they kind of look at half your picture, okay? And then if you go to your school, a lot of times, like financial aid offices, they'll be like, well, what do you want us to do? You have to understand that they're experts in getting you the loans. They're not experts in repayment. Oh, then you go call your loan servicer and say, hey, what am I supposed to do? And there's a script that they read, and by law, they have to go through and say, this is what we recommend, even though they know nothing about you. Like literally, I've been on calls with loan servicers where they say, well, we put them in it because that's what we felt was right and best for their situation. It's like, you guys don't have a fiduciary responsibility. You know nothing about this person. You're not supposed to put them in anything. You don't know anything about them. Long story short, I wanted to make sure I go through that because we get that all the time of people getting so frustrated, okay? So you have to understand why it's so hard to get help. You know, don't blame the people that you're going to just because they're not experts in it. They've never been trained in it, okay? So that's first and foremost, and that's why, another reason why we've grown so quickly is because we do know this stuff and we help you understand it, plan, and implement it for all these different things. But more importantly, you'll see this when we get to the planning and implementation phase. I'll show you how you could take this, and then you can also apply it in everything else you're doing, like retirement and family planning and mortgages and whatnot. So that's the first part about understanding, just making sure you understand why it's so hard to find help, why it's so important for you to watch this video, and we'll jump into the next section, which is identifying the risks of public service loan forgiveness. So identifying the risks of public service loan forgiveness. And by the way, if you hear me say PSLF, that's the acronym used. Sometimes people get really confused. PSLF, public service loan forgiveness, all these different acronyms. I'll try to make sure if I do use an acronym that I'll share with you and say, hey, this is what this actually means, the shortened version and the long version. Okay. Now, there are three very, very, very large risks of public service loan forgiveness. Okay. The first one is you have to actually understand what type of plan you're going to be on. The second one is that Fed loan servicing, which if you're not aware of it, if you don't have Fed loan servicing already and you go to these plans, your loans get transferred to Fed loans. Okay. The number two risk is that Fed loans, they don't give you credit for each one of your monthly payments. Okay. And the third risk is that Fed loan servicing overcharges you on your monthly payments. Okay. So once again, the three big risks are not understanding which plan you're on, the risk that Fed loans is not going to give you credit for each monthly payment you make, and last, the risk that Fed loans overcharges you on a monthly payment. So we're going to take each one of those one by one, starting with understanding what plan you're on. All right, to start off, people always come up to us and they say, I'm thinking about going on a public service loan forgiveness plan, or I'm on the public service loan forgiveness plan. And as soon as they say that, I already know they don't understand what is going on. Okay. Now, if that's you and you've done that, it's not a big deal. I would say about 88% of people don't actually realize this next piece that I'm going to go through. And that is public service loan forgiveness is not a plan. I'm going to repeat that. It is not a repayment plan. Public service loan forgiveness is a feature of another type of student loan repayment plan. And that student loan type of repayment plan is what's called an income-driven repayment plan. So that's where we're going to start. Okay. Now, those income-driven repayment plans, or IDR, okay, you have to understand what these things are. And I'll give you a perfect example. There's 7.2 million people on these. 88% don't even know how they work. Okay. First and foremost, there's 5 different versions of it. There's revised pay as you earn, which is called repay. Pay as you earn, which is also PAYE. IBR for new borrowers, which is income-based repayment for new borrowers. IBR for old borrowers. And then this thing called ICR, income contingent repayment. Most of you will not be on that, but it's important to know in case your parents have Parent Plus loans. Okay, ICR is a good one to know, which we'll talk about that a little bit later on. Okay, now we're not going to go through each and every one of those because we actually have an entire guide going through those income-driven repayment plans. Okay, so I'm not going to go through those here, but I am going to go through what you need to understand about them from a high level. First of all of them the government classifies as income-driven repayment plans, IDR. Okay, now on these plans, your required monthly payment is based as a percentage of your income. Okay, now that's really important to understand because based on my income, I might have a payment down here of, let's just say $300. Okay, now there's another thing happening on your loans. While you're in school, 99% of you probably made no payments. So what happens is your interest started to accrue. This happens because you're actually charged interest every day on your loans. This continues to happen throughout the entire life of your loan. So if you say, okay, well, if I add up all of the days in a month and my monthly interest charge, if I add those 30 days up or 31 days up, is $1,000 a month. That's how much interest I'm being charged. Now remember, my required payment might be $300. I'm not paying that difference. So just like in school, whatever interest I'm not paying continues to go up onto the loan. So therefore, how much I owe actually keeps expanding and getting bigger. Okay. Now, what happens on these income-driven repayment plans, and these are called loan forgiveness plans as well. We call them normal loan forgiveness, so that way we can make a difference between public service loan forgiveness and regular loan forgiveness. Okay, is that when you're on one of these income-driven repayment plans, they do get forgiven within 20 or 25 years, regardless of if you work at a nonprofit or not. Now, the big difference is after those 20 or 25 years, whatever you have forgiven, so let's just say my balance has grown to $150,000. Whatever that balance is, it's completely wiped out, but I have to claim that as income, which means I have to pay taxes on it. Okay. Now, public service loan forgiveness is a feature of those plans. So just to reiterate, I'm actually on an income-driven repayment plan. Now, if I'm on one of those plans and I work for a nonprofit and I work full-time and I make 120 payments while working at a nonprofit, I get my loans forgiven at the end of that 120th payment, and I owe nothing in taxes. Okay. Now that's key to understand. A lot of people say, well, it's 10 years, but it's only 120 qualifying payments at a nonprofit while working full-time. It does not have to be consecutive. It doesn't even have to be for the same nonprofit. Okay, that's two very important things. Okay, so it's 120 qualifying payments, which that's why a lot of people say it's 10 years, because 120 payments is 10 years. But I'll reiterate, it doesn't have to be consecutive. It doesn't even have to be at the same nonprofit. This is why this is the #1 risk. People don't understand the plans that they're on. Okay, everybody wants to focus on, well, what happens if I don't get my loans forgiven because of the government? That's actually not the biggest problem with these. The biggest problem that we see is that people leave the nonprofit within 2 to 4 years of working and they go to a for-profit company. Or they have children and they stay at home, so they're no longer working full-time. Or we've seen this one even. Some people work for a nonprofit and then a private company comes in and buys the nonprofit. So guess what? You're not a nonprofit employee anymore. Okay? The reason why it's so important to understand what plan you're on is because if you don't qualify for public service loan forgiveness for whatever reason, you're still on an IDR plan, an income-driven repayment plan. That tax can cost you thousands and thousands and thousands of dollars if you don't get PSLF and you don't go on the right plan to begin with. This is why you got to sit down and say, okay, well, if I don't get this forgiven, should I go and use this type of income-driven repayment plan or this type of income-driven repayment plan? And so you have to put together a game plan based on that. Okay? But for now, all we're going to talk about is the risks. Okay? That big risk is what happens if you don't get your loans forgiven. And that could be either because of the government, it could be because you're leaving the nonprofit, it could be because you're not working full-time anymore, it could be for whatever reason. So that's the #1 risk, and you have to understand what plan you're on, that they have a tax when they're forgiven if you don't work for the nonprofit for those 120 payments. That's the #1 risk. Now we're going to get in, like I said earlier, we're going to get into how do you plan and reduce that risk, as well as how do you implement that plan. But first, I'm going to talk about the other 2 risks first. So let's jump into the next one. The next risk is it's a huge pet peeve of mine. Actually, the second and third risk is a huge pet peeve of mine, because this is like you're a federal loan servicer. Your only job is to get these 2 things right, and they mess it up so many times. So many times, okay? I mean, last year, the government came out with a report that the loan servicers mess this stuff up 60% of the time. That's over half the time they mess it up. It's like, this is your job, is to get this right. Okay? The first of these 2 risks is that they don't give you credit for each one of your loans. And we see this constantly. I'll give you a perfect example. The other day I just talked to somebody, one of our FitBUX members, and she has 9 different loans. Okay? Now, She has been on public service loan forgiveness now for 12 months. Now, she did everything right. We notified her saying, hey, something's not right with this. You know, and your average number of months doesn't look correct. You know, and she called us and she's like, well, you know, your technology is saying something's not right with the plan. What's going on here? And so we dug deeper with her, and sure enough, she had 9 loans. 6 of them were getting the full 12 months of credit, meaning she had accomplished 1 year already, or 12 payments to those 120 payments. 3 of her loans were only getting 3 months of credit. So we called Fed Loan Servicing with her, and it's like, well, what's going on here? And their excuse, I mean, we hear this one all the time. Oh, it must have been a computer glitch. We didn't see it. And then they go in and they fix it. It takes them about a month to fix it, but they fixed it. Bottom line is, if you're not getting that credit for the loan and you don't realize it, and like 10 years go by, it's going to be really hard in 10 years from now to go back and try to tell Fed Loans, hey, you missed 7 months. Now it's just in 1 year. Hey, you missed 24 months. With that, it's like, how do you mess these things up? I don't know how they do it. They do it though. Okay. Bottom line is you need to be able to say, are they giving me enough credit for my loans? Now, why is this such a big deal? Okay. And how can this cost you literally thousands? Okay. These 3 loans in her case were about $12,000. Okay. If she would have kept going for the 10 years, all her other loans would have got forgiven, except for that $12,000. Plus, she would have had accrued interest on it. Well, guess what? She's probably going to have to pay those back now. That's like $12,000+ she just cost herself. Okay? And I shouldn't say she cost herself. It's actually Fed Loans costing her that. But if she wouldn't have been responsible, then she would have completely missed that, and she would have been responsible for it. And this is actually one of the reasons why you hear all these stories. Specifically, I see a lot of them with teachers for some reason, who are up in front of Congress or whatever saying, you know, I'm not getting my loans forgiven and whatnot. All they had to do was check to see if they were getting the loans forgiven. Okay, now it's not always easy. Again, when we talk about implementation, I'm going to show you an easy way to get this done. So that was number 2 risk. Again, the first risk is not understanding what an income-driven repayment plan is and how public service loan forgiveness is a feature of those plans. Why is that a risk? You're just not understanding that? Is because if you don't get it forgiven, you need to understand the repercussions. Okay, and if you don't, you can cost yourself a lot. The second big risk is that Fed Loans doesn't give you credit for your monthly payments towards loan forgiveness. And the third big risk that we're going to talk about right now is that they don't charge you the right monthly payments. The big thing here is that these are income-driven repayment plans. Therefore, your payments are based as a percentage of your income. They mess up that calculation all the time. And I'll give you an example. We just had someone that was single. They were being overcharged $150 a month. In 1 year, that's $1,800 that mistake just cost them. Now, let's just say they did that the entire 10 years. Yay, they got their loans forgiven. But because they were being overcharged, it cost them $18,000 more than it would have. And that's just for a single person. We see this all the time when it comes to being married because of the complications of how you file your taxes and all that type of stuff. Typically, when we see this mistake for married couples, for those that are using our tracking solution, we see the mistake being between the $300 and $400 a month range. That's $3,600 to $4,800 in 1 year. That a simple mistake could cost you. So that is the third big risk, is making sure that Fed Loans does not overcharge you on your required monthly payment. Now again, those are the 3 big risks. that we identified that you have to understand. We're going to talk about planning next, and then we're going to talk about implementing. And when we talk about both of those sections, I'm going to go through with you how to reduce those risks to make sure they don't happen to you, and how do you develop a plan around that. And then also go through and say, how do you easily implement this plan so that way you don't have to sit there and spend hours doing this stuff. Okay, now, before we do that, I'm going to go through some other quick things that you need to understand. So if you want to say like those first three big risks, 1, 2, and 3, those like the main things. These are like your kind of like your sub risks, that little things that people do wrong that can make it so that way you don't qualify. One of them that I already told you about is that you got to make sure you're on direct loans. Okay, and if you're not on those, again, you can consolidate your loans potentially and still qualify. Okay, the other big one that we see that people make a mistake on is that they refinance their federal loans. We get this all the time from people. They get an advertisement from SoFi or Earnest or Laurel Road, whoever it is, and I'm not knocking those companies. In fact, we're actually partners with those companies, but they just get bombarded by advertisements from these guys, right? So they're like, I'll refinance, it drops my interest rates. Once you refinance, you go to a private loan. Private loans do not qualify for public service loan forgiveness. So once you do that, you no longer qualify. Okay. The other big one that we see that people make a mistake on is that Fed loans will say, here's your required payment. Okay. And it might be $300 a month. And for whatever reason, people pay more than that because they heard that prepayments are good or whatever it may be. Again, that's just not understanding these plans. You're getting loan forgiveness. Why make a prepayment? Okay. But more importantly, if you make an extra payment on these plans, the month that you make that extra payment in, you will not get credit for that month for going towards public service loan forgiveness. So if my required payment is $300 a month and I pay $301 a month, I'm not getting credit for every month that I pay $301 or more. I'm not getting credit for that. So don't make a prepayment on these. But that's also another mistake that Fed loans makes, and we get this. We've seen this not extraordinarily often, but we do, because we don't see this circumstance all the time. But people might have an income. So for example, again, these are income-based repayment plans. So as your income goes up, your required payment also goes up. Okay. Well, we get people all the time. And I would say this probably happens about once every week or two, where they're in a job and they just don't like it, so they switch. And they go to another nonprofit, but their income might drop. So then their monthly payment drops. However, Fed loans doesn't reset their auto pay. So now their required payment drop, but their auto pay is still up here, which guess what? That means you're making prepayments. So if you don't catch that, all those payments you're making don't count. Okay, so those are the big things, again, just to understand, and a few other risks that you need to understand as well. But again, just to reiterate the big three things. The first risk, understanding income-driven repayment plans, because if you don't understand those, you can cost yourself a ton on these plans. Number 2, make sure Fed loans gives you credit for each payment you make. And risk number 3, make sure that Fed loans is not overcharging you on your monthly payment. Next up, how to set a plan to reduce all 3 of those risks. All right, so the number 1 risk is that you don't get your loans forgiven in 10 years for whatever reason. It could be because of the government, it could be because you made a mistake, it could be because you left a nonprofit, whatever reason you don't get it forgiven in 10 years. That means you're still on an income-driven repayment plan, and if you stay on that plan, you're going to have a tax at the end of it, okay? Now, first, what happens if you don't stay on that plan? You got to have an understanding of how to switch. I'm not going to talk about that in this video because that's a whole other topic, but just keep it in the back of your mind. If you do leave the nonprofit, you have to analyze, do you stay on the income-driven repayment plan or do you switch and do it strategically to a payoff plan? But for this sake, you have to understand you're still on an income-driven repayment plan if you leave the nonprofit. So let's assume that you're going to have that tax at the end of the 20th or 25th year. First thing you need to do is estimate how much you think it's going to be. Okay? The second thing is you need to know how much you need to start saving. And 3, you need to understand how the tax could change. Okay. Now, I'm going to go into each one of those right now. How much is it going to be? Okay, this is a projection done. Our tools on FitBUX.com can project this for you, both our free tool and then in our $5 a month tool, it also projects out what that estimated tax is. It's you know, the algorithm does it. If you try to do it on your own, I guarantee you're going to make mistakes. In fact, the federal government's loans makes a mistake, or their calculator, I should say, makes a mistake. The mistake they make, and this is just one of the many that they make, is one, like if you're married, they have it in separate sections where you have to put how you file, and if you get that wrong, there's a bug in their system or it calculates everything completely wrong. That's the big one. But another big one is that it assumes a 5% assumption, meaning that your income is going to grow by 5%. Well, how many of us think that our income is going to grow by 5% per year for the next 20 or 25 years when everything in the real world is around 2%, okay? So with our tool, you can very easily go in and change that. If you have your FitBUX profile built already, that tool is called Should I Pay Off My Loans or Pay or Use IDR? It's there. Or if you have our tracking solution, just log in and we tell you what it is based on your loans. There is no guessing. It's actually a real estimate at that point. Okay. So that's the first thing, is how much will it be? Now, let's just say you do an estimation. Our free tool does a 35% tax bracket. Our paid solution, it does, you can adjust that to 45%, 25%, whatever you want to do, okay? But let's just assume that's going to be 35% and we're going to owe about $100,000 in taxes. We have what we call a required minimum amount to save, and that's the first way to save. There's two ways, okay? That required minimum is the first way. So what that basically means is, let's just say I owed 100 grand, and that would be about $450 a month I would have to start saving. And so if I hit that required amount where I was saving $450 per month, and I did that for the next 20 years or 25 years, and I earned 2% on my money, it would hit that estimation in 20 or 25 years. Okay, so that's the first thing, is save that required payment. Now, where do I save it? Okay, this is something that we've seen work extremely well, and we highly, highly recommend, is that you open up an account somewhere. It could be a bank account, an online bank account, an investment account, whatever it is, open it up. And you literally put that money in that account every single month. Yeah, I mean, some people that we work with, they even do a direct deposit straight out of their paycheck straight to that account and treat it like that money doesn't even exist anymore. Okay? So that's the first way to save, is that required minimum amount. Now, the other way that you could save is to say, okay, well, that's $400 to $500 a month. I would owe about 100 grand. But maybe you're single right now. You don't have that much responsibility. You don't have children yet, married, no children. You got dual incomes, whatever it may be. And maybe you say, look, I'm going to try to save $1,000 a month for the next 5 years. So that way I'm ahead of the game in case something else majorly happens. Great. Save more than the required minimum. The more you save, the better. And that is the number one way to reduce the risk of these plans. Because let's think about this. If I'm saving and everything goes perfect and I get my loans forgiven in 10 years, fantastic. I got a bunch of money sitting there. I can do whatever I want to with it. But let's just say it doesn't go right. Well, then great. I got a bunch of money sitting there. I can either just keep saving for the tax, or I could switch and do a payoff strategy and write a big check and start paying off my loans instead. I've given myself options. You can only give yourself options if you save. And the more you save, the better off you're going to be. Okay? Now, we get the question all the time, do I need to save for the full 10 years? We recommend doing that just to make sure that you can get it forgiven during those 10 years. But if you got some other goals in mind or whatnot, we recommend at least saving for 2 to 4 years. Why 2 to 4 years? Statistically, based on those that are using our tracking solution, in that 2 to 4 year span is basically when we see people leave the nonprofit for whatever reason. Okay? Either A, you're going to leave and they know that, or B, they know they're going to stay for the next 6 to 8 years. And so if that's the case, then you could potentially use that money for like a down payment on a house or whatever it may be. Okay? How and where do you save it? Again, we recommend opening up another account. Some people will put it into a Roth IRA, and that just depends on strategically what the dollar amounts are and what you can do. Some people will just put it onto an online savings account, and some people will say, well, I'm going to do a regular account, so that way in 2 to 4 years, if I feel I'm going to stay there, I'm going to use it for a down payment for a house. Again, that's a highly customized thing on where you save it. So if you do need help with that, just let your FitBUX coach know, and we'll walk you through your scenario and see where you should be saving that at. Okay. Now, that's the first two things. How much is it going to be, and how much do you need to start saving? How much do you need to start saving can be one of two things: the required minimum amount, or just save way more than that in the short run because you can. Okay. The last thing we're going to talk about on this risk, the tax rate. This is one of the biggest risks on an income-driven repayment plan. We project these at a 35% tax bracket. Taxes can change. Happens all the time. That estimation is going to move up and down every 2 years as new Congresses get in and taxes change. Okay? The other things that can make this change is your income, like big bonuses or getting married. That can all change your monthly payments on these, which change your tax. And if you have children, that's another big time where we see these things change on a monthly payment. Bottom line is that tax estimate is just that. It's an estimate. So you need to constantly be aware of what it might be. And if one of those three things happen, your income changes drastically because you go up in income or down in income, whatever it may be, or you get married, you have children, or the tax rates change, you need to sit down and look at this again and say, what is my tax estimate now? Do I need to change anything to how much I'm saving? So again, those are the big three things there. That is how you reduce the risks of being on an income-driven repayment plan. There's actually only one way: save, save, and save some more. Okay. Now, the thing is about your loan servicer not giving you enough credit each month, as well as if they're overcharging you every month. Saving also benefits you there too. Because let's just say for whatever reason that happens to you and you don't get your loans qualified, or they're overcharged, whatever it may be, the more you save, the more options you give yourself. So down the road, if something happens, you can turn around and say, well, I want to stay on this, or I don't want to stay on it. The more money you have, the more options you give yourself. And that's just a financial lesson in general. Anything you do financially, the more options you give yourself, the better. Okay? So that is how you develop a plan. We are now going to go into how do you easily implement it. All right, the first part in implementing it is which income-driven repayment plan do you use? Like I said earlier, there's 5 different versions. Okay, now, which version for you to go on is very, 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 very customized. However, if you're just trying to use a general rule of thumb, about 90% of the people that we work with, you're either going to go on IBR for new borrowers or PAYE, which is pay as you earn. If you're going to ask what's the difference between those, there's actually no difference. It just really depends on when you took your loans out. They changed the name of it, but it's actually the same exact plan. Okay, so if you're just have questions about which one you should be on, should be pay as you earn or income-based repayment for new borrowers. Again, if you want a deeper dive into your situation and you have our solution, just feel free to sign up or schedule a call with your coach, and we should be able to go through and say, hey, this is which one you should go in or not. But in general, income-based repayment for new borrowers or pay as you earn. Okay, now, these next steps are extremely important for you to do. Okay, first and foremost, you got to be on an income-driven repayment plan. Okay, what that means is that you have to certify your income every year. So you literally have to put your income to the government, whether it be your pay stubs or your tax returns, and then they do this calculation, and then they say, here's your monthly payment for the next 12 months. Okay, that's the payment I said earlier that oftentimes they miscalculate. Okay, but that is the key thing there. Now, the government actually just passed a new law at the end of 2019 that they're automatically going to take your tax returns from the IRS and send them to Fed loans, so you don't have to submit this form anymore. When that system is actually going to be put into place, it's the government. It might be 10 years from now. Who knows? Okay. Bottom line is for now, you have to certify your income once a year. Do not ignore those notices because if you do and you get kicked off, you can always go back on, but you're going to miss some months of payments. You're going to have interest that's capitalized and accrues more interest now. You just don't want to deal with that. Make sure you certify your income. Okay. And the second component of this that's extremely important, the employment certification form. Okay. So if you go into Google, type in employment certification form, it's going to be the first PDF. Take that to your employer, fill it out, send it in. Okay. The reason why that's so important is because, first of all, that's going to take your loans, if they're not already there, and move them to Fed loan servicing. But more importantly, it's going to make sure that your employer qualifies, that you qualify, your loans qualify, and that's how you know these things happen. Now, you don't get something back from them saying this is all the, you got credit for this, 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 and this. That would be too easy, right? They put it in places that are sometimes difficult to find and all that type of stuff. The bottom line is that it's there. And the big thing is if you don't qualify for whatever reason, you will get a letter back saying you don't qualify. Okay? And then you can figure out why. That's one of the biggest problems with this. I have some, I'll give you a perfect example. My wife, who works in healthcare, she works at a nonprofit hospital, but she's a physical therapist, and all the physical therapists and all the MDs all work for a private company that's basically contracted by the nonprofit. Therefore, none of them qualify for public service loan forgiveness. None of them would have known that if they didn't file that employment certification form. You have to fill that out. Now, the government recommends you do that once per year. Okay? We don't trust Fed loan servicing. So we recommend doing it every 2 to 3 months. Why? Because it typically takes them about 2 months to get it back to you. So what we say is file it, and then when you get that return back to you, file another one, and just keep filing it, and then make sure that you're storing your documents so that way you have a place to go back to and say, here's the document. If they make a mistake, you can point to it and say, here it is. Okay, now if you need help with that or a place to store it, that's on our Tracky Solution stuff. You can upload it there too and just keep it all in one place for you. But just make sure, even if you're not using our Tracky Solution, that you have a place to store those documents. I can't tell you how many times we get on the phone with people and it's like, what plan are you on? Or did you get credit for this? And they're like, I don't know. They sent me something. I just don't know where it's at. You got to know where it's at, because if they make a mistake, they sent me something, I just don't know where it's at, it's not going to fly. You got to have evidence. Now in the beginning, I mentioned to you I was going to talk to you about an easy way to implement this. But before I do, I'm going to ask you a question. The average person that gets their loans forgiven on public service loan forgiveness will save $62,000. In your opinion, is spending $300 to potentially save $62,000 worth it? If the answer is yes, then our implementation method is going to be what you want to do to make your life easy. We call it our public service loan forgiveness solution. You've heard me reference it a few times during this guide and when I was giving you some of the examples about some of our members that use it. Okay. What it does is you link your student loan accounts to your FitBUX profile, and then you also link the account where you're saving the money for the tax. And it will do everything that you need that we talked about in terms of designing the plan and then implementing it. One, it's going to project out what your tax would be if you don't get your loans forgiven, and it's going to tell you here's a required minimum amount to save. And because you're linking that account to your FitBUX profile, it will constantly update to tell you if you're saving enough or not. And if your income changes, or if you get married or have children, or the tax rates change, can update right in that technology like that. So you don't have to do the calculations anymore or anything. You just log in and there it is. Are you saving enough or are you not? Okay. The other thing that we do with that is that you have access to our FitBUX coaches, and you can call us anytime you want to, and it's free. We don't charge extra for that. and just say, look, here's my situation. Should I be on pay as you earn, repay? I'm getting married. Should I stay on it? Should I not? All that type of stuff, you can call us and ask. And if you have any problems with Fed loans, that's why we know so much about this. We'll call them with you to make sure they get your loans forgiven for you, okay, and that they fix their mistakes. Now, in terms of those other risks that we talked about Fed loans not giving you credit on a monthly basis, we track it for you. Literally, all you have to do is log in and expand the loans, and it will tell you if each and every single one of your loans got credit. But that's also another reason why that employment certification form is so important to fill out and do every 2 to 3 months. The only time Fed loans updates that information is when you send that in. So by sending that employment certification form in, every time you do, it will update on your FitBUX profile and tell you if you're getting credit for all the loans or not. Now, the reason why it's so hard on Fed Loan Servicing's website to see if you're getting credit, because all they do is show you an average. They don't show you each loan broken down. We do. And the third big problem of them overcharging you, guess what? Our technology will tell you if they're overcharging you. So it helps you plan in case you don't get your loans forgiven by showing you how much you need to save for the tax and updating it and telling you if you're saving enough for the tax. It will make sure that you're getting every single month that you make a payment and you're getting credit for it. And third, it will tell you if they're overcharging you on a monthly basis. Now, this is a special we're having right now. I brought up that $300 earlier. We normally charge $5 a month. So if that's over 10 years, that would be $600 that you would have to pay over those 10 years. Our special right now is if you pay one lump sum fee up front of $300, you get the tracking for the full 10 years. You can call us whenever you want to, email us whenever you want to. We'll help you whenever you need it. That's what we're here for, okay? So that is the absolute easiest way for you to implement this and make sure that there's somebody on your side instead of you trying to have to go up against Fed loans by yourself. Now, that's the big thing of understanding, planning, and implementing your strategy for public service loan forgiveness. So those are the questions that we typically get. If you have other questions, be sure to reach out to us, sign up for our solution, and let us know. Again, if you think $62,000 is worth savings, again, where do I even get that $62,000? That is the average savings for people on public service loan forgiveness. If you think that's worth it, and you think that spending $300 would be a good investment to make sure you get that savings, be sure to sign up for our tracking solution. If you found this video and this guide helpful, make sure that you share with your friends, share within the podcast, download our checklist, make sure you're doing everything right. If you have questions, let us know. Talking to you soon.